Good evening from New York. It's 5:52 p.m. on Tuesday, April 7th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is currently closed, and we're recording this as the clock ticks toward the most consequential geopolitical deadline markets have faced all year, the president's 8 p.m. Eastern ultimatum to Iran. Let's get right to the numbers.
So here's your tape. The S&P 500 closed at 6,617.92, up a barely perceptible 9 basis points. The Nasdaq edged higher, 22,024.8, up 0.13%. The Dow actually finished red, 46,591, down 17 basis points, and the Russell 2000 managed to squeak out the best of the bunch at 2545.57, up 19 basis points. The VIX at 25.74 tells you the market is bracing for something that's elevated but not panicking. The advanced decline line was 263 to 247, so breadth was almost perfectly split. What's structurally significant is the rates picture, the 10-year at 4.34%, the 2-year at 3.62, giving you a normal yield curve with a 72 basis point spread. This is a market caught between three forces tonight: the binary outcome of Trump's Iran deadline, a 4.5% drop in crude oil on the session as traders hedged diplomatic hope against escalation risk, and the tech tape that showed real divergence underneath the surface. Those are the three threads we need to pull apart.
Let's pull the biggest one first. Crude fell over 4.5% today. That feels counterintuitive when you have a president threatening to destroy a civilization by tonight. What's the market actually pricing?
It's pricing optionality, specifically the possibility that this deadline doesn't end in escalation. WTI settled at $110.34, down 4.57% on the session. Brent fell even harder, down 5.42% to 105.47. The session decline happened as Pakistan's prime minister publicly asked for a 2-week extension, and diplomatic signals from Oman suggested back-channel movement on reopening the Strait of Hormuz. But here's the critical context. Even after today's pullback, crude is still at levels that are doing real economic damage. According to Airlines for America, citing Argus data, jet fuel in major U.S. cities hit $4.69 a gallon on Monday. That's up nearly 88% since February 28th when the war started. And according to AAA, national average gasoline hit $4.14. The causal chain here is specific and measurable. Hormuz closure chokes crude supply. Crude at $110 pushes jet fuel near $5. Airlines respond by cutting capacity. UBS reports total second-quarter airline capacity growth was trimmed from 2.4% to 1.1%. Then Delta and Southwest raised checked bag fees by $10 each today, joining United and JetBlue from last week. Meanwhile, consumers at $4 gas start changing behavior. AAA data shows 59% of Americans alter driving habits at $4, and that figure jumps to 75% at $5. CNBC's own housing market survey found that real estate agents now rank the war and gas prices ahead of home prices as buyers' primary concern, and contract cancellations are rising. So what oil did today on a single session is interesting, but the damage already baked into the real economy is the story investors need to track.
And the secondary stories? Apple took a dive intraday and then recovered, while cybersecurity had a monster day. How do those connect to the macro picture?
Apple fell as much as 5% intraday on the Nikkei Asia report of engineering delays for its foldable iPhone, but Bloomberg later reported the September launch remains on track and the stock recovered to close at 253.49, down only 30 basis points. What's notable is the data profile. Apple trades below its 50-day moving average of 260.63, but above its 200-day at 249.41, and it's down 6.37% year-to-date. It absorbed a 5% intraday shock and snapped back. That tells you the 200-day is acting as real support, and the market wanted to buy the dip. That said, for a $3.76 trillion company, the foldable iPhone is the next product cycle catalyst, and any genuine delay would be structurally significant, given iPhones drive over half of Apple's $143.8 billion in quarterly revenue. Then cybersecurity, CrowdStrike surged 6.08%, Palo Alto Networks rose 5.16%. The catalyst was Anthropic announcing Project Glasswing, a controlled rollout of its Claude Mythos Preview AI model with advanced cyber capabilities to over 40 companies, including CrowdStrike and Palo Alto. The controlled access approach eased fears from last month when Fortune discovered the model's capabilities and cybersecurity stocks sold off. The connection to the macro backdrop is direct, with AWS data centers in Bahrain and UAE damaged by drone strikes. The AWS CEO confirmed they have teams working 24/7 to keep regional services running. The intersection of geopolitical risk and digital infrastructure vulnerability is now a live investment theme, not a theoretical one.
That AWS detail is striking. A hot war physically damaging cloud infrastructure from the world's largest cloud provider. What does the rates and yields picture tell us about how the Fed is reading this environment?
The 2-year at 3.62% is your market proxy for where Fed funds should be, and it's telling you the market believes the Fed is essentially at or near terminal. The 10-year at 4.34% with a positive 72 basis point spread gives you a normal curve. The market expects eventual easing, but not anytime soon. Here's the critical distinction the Fed will draw. This is an energy-driven headline inflation shock, not a core inflation problem, yet. Jet fuel up 88% since February, gasoline up roughly $1 a gallon since March. These are enormous numbers, but the Fed's reaction function requires those energy costs to feed through into core inflation and unanchor inflation expectations before they tighten. Historically, the Fed looks through energy shocks unless they persist for multiple quarters. The problem is we're now in week 6 of the Hormuz closure with no clear resolution. If oil stays above 110 through the summer, you will see second-round effects: food prices via fertilizer costs, freight costs up 30% from Vietnam, according to Sourcing Journal, airline capacity cuts that raise airfares, and consumers who are already telling CNBC they're cutting discretionary spending. Our read is the Fed holds through at least June, probably through the year. The 2-year is pricing a possible cut in the second half of 26, but only if growth deteriorates enough that the energy shock tips over into demand destruction. This is a holding pattern, and the only thing that changes it in either direction is what happens at that straight.
So, who are the clear winners and losers from today's session?
On the cyclical winner side, the technology sector dominated the gainers list. 8 of the top 10 gainers were tech names. Seagate jumped 4.93% after Morgan Stanley raised its price target and named it a top pick on brighter hard disk drive demand. Western Digital rose 4.76% on the same Morgan Stanley call. Arista Networks gained 4.49%, benefiting from the Broadcom-Google long-term AI chip and networking deal announced this week. Corning added 4.27%, riding the AI infrastructure build-out theme. Keysight rose 3.44%. Dell was up 3.16%. The cybersecurity names we discussed led the broader tape in absolute terms. On the structural winner side, the sector breadth data is unambiguous. Energy has 90.91% of its stocks above the 50-day moving average, 72.73% near their highs, and 0% near their lows. Those are the 2 safest neighborhoods in this market right now.
On the loser side, Axon dropped 9.05%, the steepest decline in the S&P, though there's no identified catalyst beyond industrial sector selling pressure. The trade desk fell 6.33%. Ad tech is highly sensitive to macro uncertainty and consumer spending pullbacks. Campbell's declined 4.7%, and Kimberly-Clark lost 3.54%, both consumer defensive names getting squeezed by input cost inflation from the energy spike, which is a notable pattern. Even the traditionally safe consumer staples can't hide when their raw material costs are surging. Molina Healthcare dropped 4.14% in a managed care sell-off. CoStar fell 3.94%, directly tied to the weakening housing market we discussed. Now the structural breadth extremes. These are the numbers that should make portfolio managers uncomfortable. Consumer cyclical has only 7.55% of its stocks above the 50-day moving average. That's 4 out of 53 names in a $6.25 trillion sector. That is broad-based capitulation. Nearly 19% of consumer cyclical stocks are near their lows. Healthcare is almost as weak, 15% above the 50-day in a $5.5 trillion sector. Industrials are at 17.81% with 15% near lows. Financial services, 70 stocks, 7.63 trillion in market cap, has only 20% of its names above the 50-day. These are massive sectors quietly deteriorating while the headline indices grind sideways.
Let's talk about the Magnificent Seven specifically because they're a huge part of why the headline index looks calm while the internals look stressed.
Exactly right. Alphabet was the standout today, closing at 305.45, up 1.11%, and it's up 6.22% on the 5-day. The Broadcom partnership on long-term AI chip and networking deals is giving it a near-term narrative. NVDA closed at 178.10, up 1.34%, trading below its 50-day at 182.31 and just below its 200-day at 180.13. It's at a technical inflection point. Amazon closed at 213.78, up 1.32%, but it's below both its 50-day and 200-day moving averages, and the AWS Middle East situation is a real operational risk that's being underpriced. Microsoft at 372.27, up 52 basis points, but down 21% year-to-date, and trading well below both its 50-day at 399 and 200-day at 474. That's a structurally broken chart. Tesla, at 346.56, down 24 basis points, is down nearly 7% on the 5-day and almost 21% year-to-date, trading far below both moving averages. Meta at 574.91, up 80 basis points, but down 11.5% year-to-date. So 3 of the Mag 7, Microsoft, Tesla, and Meta, are in correction territory year-to-date, and yet the S&P is essentially flat. That divergence between the index and the underlying breadth is what makes this market fragile.
With the deadline 2 hours away, what's the risk case investors should be stress-testing tonight?
Let me give you the full framework. Our base case, which we assign 50% probability, is that the S&P trades in a range of 64.50 to 67.50 over the next week. The 10-year holds between 420 and 450, and WTI oscillates between $100 and $120. The trigger for this scenario is that either Pakistan's 2-week pause proposal gets accepted, or the deadline passes with rhetoric but no escalation against civilian infrastructure. Markets stay range-bound, the VIX drifts between 24 and 28, and the Fed holds through June and beyond. The damage to consumer sentiment continues to build slowly, but no acute break occurs. The risk case we assign 30% probability is that Trump follows through on strikes against Iranian civilian infrastructure, bridges, power plants, the targets he publicly named. That triggers prolonged Strait of Hormuz closure, potential retaliatory strikes on regional infrastructure. Remember, AWS data centers in Bahrain have already been hit. In that scenario, WTI goes above 130, national gasoline pushes towards $5 a gallon, which is the threshold where 75% of Americans change behavior, according to AAA. Airline capacity gets cut further, consumer discretionary spending collapses, the housing market freezes, and the S&P could test 6,100. The 10-year would likely push towards 460 as inflation expectations re-anchor higher and risk assets sell off simultaneously. The upside tail, 20% probability, is that Iran agrees to reopen the strait as part of a ceasefire deal before or shortly after the deadline. That would rapidly collapse the war premium in energy, potentially bringing crude back towards $80 to $90, immediately relieve airline fuel costs, boost consumer sentiment, and unlock a relief rally. In that scenario, the S&P could run towards 6,900, led by the war-depressed cyclicals, consumer discretionary, industrials, and particularly the airlines. headlines. For positioning, here's my conviction ranking. Highest conviction, energy producers. Maintain or immediately increase exposure. The breadth data says this sector is in full participation mode, and even in a diplomatic resolution scenario, the structural supply constraints from underinvestment don't disappear overnight. Secondary conviction, utilities as a defensive allocation. 0% of that sector is near its lows, and in any scenario where rates don't spike dramatically, utilities are your ballast. Tactical play, cybersecurity names. The Anthropic Glasswing announcement validates the structural demand thesis, and CrowdStrike and Palo Alto are positioned at the intersection of AI and security spending, which doesn't slow down regardless of the geopolitical outcome. Avoid list, rate-sensitive consumer cyclical names. The breadth data is screaming with less than 8% above the 50-day moving average, and the consumer is being hit simultaneously by $4+ gas, rising mortgage rates at 6.5%, and deteriorating confidence. Consumer staples are also a trap here. Normally defensive, but Campbell's and Kimberly-Clark showed today that input cost inflation is eroding even their margins.
How does all of this fit together?
When you step back, this is really about the market being structurally unable to price a binary geopolitical event, while the underlying economy is already absorbing a slow-motion energy tax. The headline indices look calm. The S&P was up 9 basis points, but under the surface, consumer cyclical breadth is at crisis levels. Staples are getting margin crushed, housing is freezing, and airlines are cutting capacity while raising fees. The oil pullback today was the market's way of hoping for diplomacy, but even at $110, the economic damage is accumulating. Delta reports tomorrow morning, and that earnings call will be the first real stress test of corporate America's ability to absorb triple-digit oil. If Delta's refinery advantage and pricing power hold, airlines could stabilize. If the guidance includes material capacity cuts or margin compression, that's your signal that the energy shock has started consuming the real economy, and you want to be overweight energy, overweight utilities, and significantly underweight anything tied to discretionary consumer spending. Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.